Hello, everyone, and welcome to the latest edition of LPL Market Signals. Jeff Bookbinder here, Chief Equity Strategist, LPL Financial, with my friend and colleague, Jeffrey Roach, Chief Economist, LPL Financial. How are you today, Dr. Roach?
Hey, doing great, and I'm glad to say that I'm calling in today from the Fort Mill office. So I crossed state lines here, came down from North Carolina to South Carolina.
I'm always surprised when I hear how much traffic there is down there, but glad you made it. Glad you had time to bring the heart rate down to get ready to bring it back up again with an exciting markets discussion.
Hey, I have driven a 9-passenger Peugeot van in Moscow, Russia, so I can handle the trip down to South Carolina.
Wow, they're very impressive. I would probably not recommend doing that right now, but good background to have nonetheless. So let's get into it. We are titling today's podcast, Jackson Hole Jolt. Certainly the markets got jolted on Friday. Some of that selling pressure carried over into Monday. So we'll talk about that first. And related to that is the Fed getting whipsawed again. They were late to tighten ahead of the inflation surge, mischaracterizing it as transitory. Now they could be wrong again by getting too tight or staying too tight too long and driving the economy into recession. So we'll talk a little bit about that. The third point, corporate America, just going to do a really quick recap of earnings season because it's in the books and it was pretty good, all things considered. Then lastly, is energy a buy? The energy sector has been picking up here recently, and we think looks like an interesting opportunity. So let's start with the Jackson Hole Jolt. Jeffrey, you're one of our primary Fed watchers and certainly have, I know, some thoughts on what Powell told us. I mean, you could make an argument that what he told us is what we already knew, but he did it with such force that clearly the market repriced Fed rate hike expectations higher. So my question for you is, did the market, actually two questions. Did the market interpret the message correctly? And is, this sort of expectation now built into Fed funds reasonable, or is it still not tight enough?
Yeah, those are great questions, by the way. So, you think about there are so many ways to make an error, right? On the way up, on the way down, as you referenced on the previous slide. And those of us that have kids know also firsthand that there are so many ways to make a mess, right? And so it's certainly possible. The Fed has talked about this, their dual mandate. They can emphasize one mandate over the other. They actually do that all the time. It just doesn't always get the press, and it always doesn't last as long as it has in this current cycle. So yeah, they've always said, hey, we're going to emphasize growth and on purpose. And now currently they're saying, hey, we're going to emphasize the inflation risk. You could argue there's not much we learn from the speech other than, hey, we're serious now. Take us seriously. And that was the point of the short but not so sweet remarks that Powell gave. By the way, just want to highlight, Jeff, we don't talk a lot about this, but there are a lot of other very interesting speeches going on in this symposium. Central bankers from literally around the globe are there. And so you hear from them. You also hear from a lot of academics all over the place. Some academics are more dry than others, as we can all remember from graduate school or college. But there's a lot of interesting things going on that don't make the press. By the way, they don't stay in 5-star resorts. It's pretty bare bones. You have to watch a Mike McKee Bloomberg special he did several years ago where he toured where they all stay. But looking at this graph, we have a 50 basis point, expectation for September, and then, 25s and 25s. I think the new thing, given how serious the Fed is on fighting inflation, is that, hey, they're not going to pause until maybe March. You can see that's where the columns really peak and kind of flatline. Before, we thought, hey, probably maybe February could be where they kind of pause and wait and watch and see. So everything's been pushed out maybe a month or two. And then, of course, you can see the declines in the latter half of next year. But in the near term, 50 basis points September, 25, November, December, something we've been talking about for a very, very long time.
Yeah, so that suggests that maybe the market's got it about right at this point. But certainly the market doesn't have a lot of confidence yet that it has it right. And that's why, stocks maybe in the near term are going to be a little bit choppy. So here's the S&P 500. Of course, we had this sell-off on the Jackson Hole speech. In fact, we said last week on the podcast here where with Quincy Crosby that, maybe after failing at the 200-day, we would just go right back to the 50-day. And that's basically what we've done. Stocks are up. We're a little bit here this morning. We're recording this on Tuesday morning. We'll see where we close here. But the 50-day is certainly support. But below that, it's 3,900, which is the May lows. So that's the key number to watch here. We're calling for choppy. But after we get through this seasonally weak period of September, which you can see right here, September, one of the weakest months of the year historically, whether you look at 10 years, 20 years, post-World War II, even just highlighting midterm years, September has, on average, been quite weak. So this is not necessarily a great time to look for a rally. However, look what's coming around the corner, October, November, December. Very, very strong historically, and even stronger in midterm years. So we've talked a lot about that pattern, and we're getting closer. We're closing in on just 2 months, right? The 2-month mark ahead of midterm elections. So the seasonal pattern we think will work, and we'll have a nice Q4 rally. But in the near term, the market needs to get comfortable with inflation. It needs to get comfortable that it's got this Fed path right, and then can maybe start to make a rally here next month. So that's some brief comments on the Fed. Let's turn to, on a related note, the inflation challenge, right? Also Fed related. There is a risk that the Fed is wrong twice, right? Wrong by being too late with the hikes, and now wrong by hiking too much. So, on this, we've got a list of a number of reasons, Jeff, that or pieces of evidence that inflation is falling. Right.
That's right.
Right as the Fed is getting hawkish. I mean, they've been hawkish for maybe, a couple of months here, but this is right as the hawkishness is really ratcheting higher. And this is right when we finally started to see some evidence. So we have a list here, not even a complete list. I'll bring each one of these in one at a time, but a list of evidence that inflation is falling right as the Fed gets tighter.
Right. Yeah, maybe the best ways is inflation is decelerating, still, above the target, but decelerating. And let me just briefly say, relative to your previous slides, Jeff, whenever we're in a point of inflection, markets will be volatile. I think that's kind of the basic takeaway, kind of that elevator pitch point that you want to take away from that, that inflection implies volatility. So here we go. Yeah, expectations are down. We can go through this list pretty quickly. Commodity prices, think about oil, think about lumber, right? That's down. The shifting away from goods, services, remember that pivot to services, goods to services, that movement back and forth. So think about durable goods prices have eased in the last several months. Supply chain improves. You've heard us talk about this for a very long time. I'm going to talk a little bit more about that in another slide. Money supply as the Fed institutes its tightening process. Keep going there, Jeff, with the next bullet point. Fed hikes. Remember, we're seeing now the effects in the real economy of what the Fed did in previous hikes, 2 months ago. Next bullet point is, U.S. dollars. So that implies falling import prices. That's going to filter through to an easing of consumer prices domestically. Next one is higher mortgage rates, certainly cooling the housing market. And, a lot of flux going on there. I don't know, by the way, as we said, look, this is kind of a highlights. We didn't even talk about shipping costs have gone down. Times of shipping from port to port has gotten shorter. All this stuff, of course, is setting us up for kind of that easing of inflation. So if you go to the next slide, you can actually see the actual decline in prices. And I showed this before, but it's just worth talking about here just briefly. Is from a core standpoint, if you look at durable goods, for example, they've started to ease back in February. We started to see headline now ease in July. We got to wait a little bit till we get August numbers, but we already know August is going to cool as well from the impact that we've seen from more high frequency data. So if you go to the next slide, even just kind of moving this along, is to say, okay, if you look at from Friday's deflator number, which is the preferred metric for the Fed, you look at that top half of the shaded areas, that lighter blue color, that's supply driven contribution to inflation. That's roughly half of the 6% year-on-year gain in inflation in July. So half of that is supply driven. And so that's why, we've talked about, the Fed's tools do not address supply side. And I think that's why it's so important to keep on talking about that. Sometimes we feel like we're in a broken record, but I think clients can appreciate that when we talk to end clients. We say, look, half of the inflation pressures right now are COVID related, pandemic related, reopening related. And so hence you could have some of that reversion and easing in the very near term. So go to the next slide. That's all I wanted to say about supply chains. And I'll tease this up briefly, Jeff, on just the profit margins. I'll throw out the profit margin conversation that we had in our asset allocation committee meeting yesterday. And I'll leave it there and toss it to you. Talk about corporate America.
Yeah. So thanks, Jeff. Just to wrap up the inflation discussion, I think it's frankly remarkable that according to the University of Michigan survey, inflation expectations over the next year are down at 2.9%. So I put that one first. That is, hopefully we get that in a year, but that certainly has come way down. I think it peaked at like 4.5. That's come way down, and it's certainly, I think, good to be at the top of that list in terms of evidences that inflation's falling. So yeah, let's turn to corporate America. Yeah, I mean, you're right, Jeff. The profit margins, that was one of the keys that we wanted to watch this earnings season, and I would say that it's been as good as you could have hoped, frankly, to just have modest downward pressure on margins, and it wasn't too much pressure to prevent companies from meeting their Q2 targets, right? The final growth number for earnings in Q2 looks like it's going to be 6.2%. That's only a couple points of upside, but given the challenges, that's not bad at all. I mean, remember before the pandemic when the numbers just started to get pretty wacky in a good way, upside of 3-4% was normal, right? So to do that with supply chain challenges, with slow economic growth, with a dollar that's at a 20-year high and has been surging, right? Cost pressures, inflation really intensified in Q2. All of those challenges, geopolitical challenges as well, let's not forget that. To still deliver 2 points of upside's pretty darn impressive. Now, we did expect estimates to come down, and they sure did, but frankly, I think just about everybody expected estimates to come down. But because margins hung in there and revenues were so strong, and frankly, companies are just doing a good job of managing costs, they didn't come down dramatically. So we're still, the LPL Research forecasts are still below consensus forecasts. And in the case of 2023, dramatically so. I mean, $8-9 of S&P 500 profits. Now, keep in mind, though, that the Inflation Reduction Act is going to probably take $2 to $3 out of 23 profits. So maybe we're really more like 241 at this point, if you adjust that consensus number. But that's still $6 above where we are, 235. So we still feel good about those forecasts. And frankly, to miss those by any meaningful amount, we'll need a recession. Hope we don't get it, but that would be the scenario that would cause us to miss those earnings estimates. So let's go to our last topic, Jeff, kind of Rapid Fire, which is on energy, and is energy a buy? And, we get it's a controversial investment to make, with the ESG movement and all. But setting that controversy aside and just looking at sector fundamentals, frankly, it's more than fundamentals. It's valuations too, with technicals as well. The sector looks like a pretty good opportunity. We did a blog on lplresearch.com last week. By the way, our weekly market commentary this week is on earnings. You can find that on lpl.com. But the blog last week, I believe it was on Thursday, highlighted energy as an opportunity. This is just relative strength. And, if you try to sort of build a case for a sector, I think, it's the old adage, right? Buy low, sell high. When you get a sector that's fundamentally strong, which we think energy is, and you get it on a dip, that tends to be a good opportunity. And look at what we've got with energy here. We had this pretty big, sell-off in energy. Relative strength came back quite a bit after the surge earlier in this year. And now we're starting to make some more progress. So if we can actually, on this chart, maybe the scale is a little misleading, but if we just get back to the relative strength highs that we set in June, this is, another 15 percentage points of excess returns. The sector has outperformed dramatically this year, but we actually think it can continue to make a run. So, Jeff, what do you think about energy fundamentals here and oil? I mean, the supply is still tight, and we're not getting good demand out of China right now, but the demand story in the rest of the world is pretty good, don't you think?
It's really kind of mixed. So if you look at, leisure travel and just the demand to move around and get out there, it's still there. So that's from the consumer side. From the corporate side, of course, manufacturing kind of continue to kind of recover and a little bit of a rebound as supply has improved. For example, industrial production for autos has increased recently because of access to supply chips. So when you look at industrial production, which tends to correlate with energy, a little bit of upside. One thing that maybe tampers my expectations a little bit, this came out from a Stanford economics prof recently, given the hybrid work from home, there are billions of less commuting miles happening these days than, before pandemic. So that's kind of tampering demand. But I think in the near term, there's a little bit of that upside as industrial production ramps back up.
Well, you helped with those commuting miles today, I know, and I'm going to start helping a little bit more here before long. I had to recover from my hip surgery first before I was going to go into the office, but doing much better and probably going to head in later this week or early next. So this is a chart of oil. I mean, I agree that the demand picture is not great. It's not, table pounding buy here for energy. But, the supply side, we certainly are getting some tight supply out of OPEC plus. And I've just heard recently from the Saudis that they may cut production back further to support prices. They said they're worried about recession. So we'll see what happens there. But, we also have tight inventories here in the U.S. We are exporting a record amount of petroleum products. The last weekly report on inventories was a pretty big draw, which provided support for this latest bounce. So, now oil's kind of at this crossroads where the 50-day and the 200-day meet. The 200-day is still upward sloping, which we can't say about the stock market. So, maybe oil makes another run back to, maybe not back to recent highs in the 120 range, but certainly we could see oil, retracing maybe half of this recent decline and getting back to like 105, 110. We don't want oil to go higher. But the near term, especially with what's going on in Europe right now, the near term outlook looks pretty positive. So, we try to be action oriented here on this podcast and give people ideas for how to manage portfolios. Here's an idea to look at if you either have no energy exposure or modest exposure. It might be time to look at it.
Yeah, I was just kidding. From a big picture story, you think about what's crimping supply, and that is just access to qualified labor. to get down there. It's one of the things that it's really important to watch the ducks, as they call it, DUC, drilled but uncompleted. And it's been interesting. It's kind of tracking, firms that are in the business saying it's a little bit challenging to get workers to provide, the services that these energy producers need. So that's, I think, something to think about from the supply angle.
Sure, and something that's pushing the inflation problem in the wrong direction, right? Tight labor markets. So more labor can put downward pressure on inflation in a number of different industries, and certainly oil is one. So good discussion there, Jeff. We'll keep watching energy closely, but it looks like it's poised to make another run. So let's wrap up by just looking at what else is coming this week. If you look at this list of big economic reports, I think your eyes immediately are drawn to the jobs report on Friday. Consensus is 300,000 new jobs on Bloomberg, and the unemployment rate is expected to remain unchanged at a very low 3.5%. So I guess, Jeff, it's a good news is bad news is good news kind of market environment with everybody so focused on the Fed. What do you expect on Friday?
Yeah, I think we're looking for probably a sub 300. That's what I'm, expecting. You're thinking about, that's still a big number historically. And I think it's important to put it in context, so previous month, over 500,000 gain in jobs. It's possible that some of those were double counted, people holding more than one job, multiple job holders. But nonetheless, I think the big story that we need to see is, an easing, a slowdown that's controlled and measured as the labor market cools. So, going from, 700,000 job gains in 1 month to 600 to 500, if we're a little sub 300, that's good news in that the economy is in the labor market that is slowing, but it's slowing in a measured pace, not completely contracting. So that's going to be important to watch. I think most important too, the Thursday morning claims numbers, and they're just showing that there is indeed weakness. And of course, our call right now is still probably a coin flip on recession in the beginning of 2023 or maybe the Q4 of this year. And so we need to watch the labor market closely because that's going to help us identify and change those odds when we need to, the probability of falling in recession. At this point, I think we can eke out some growth in the third quarter and rising risks for Q4 this year, then certainly even higher risks for Q1 next year. That's putting it in perspective, right? We're watching all these weekly economic indicators and market moves. Big picture is, okay, what is this telling us about where we're heading and the forward-looking projection? So there you have it. Recession risks rising more in Europe than in the U.S., but clearly recession risks are rising.
Yeah, I think on the jobs market, something around 200, maybe even a little lighter than that would be fine. Still job growth, but slower and more evidence that the Fed is getting what it wants in terms of a cooling job market. But in terms of recession in the U.S., the data that we've seen over the past couple of months, Jeff, I think is pointing to, potentially, 2% GDP growth in Q3, maybe even a little bit more.
For Q3, yeah, for Q3, with we talked about this in a blog post recently that retail sales adjusted for inflation. You got to do that on yourself because census doesn't report it in real terms. It's nominal, but when you adjust for inflation, real spending grew in July. So first month of the quarter, we still have a little bit more to go. We shouldn't be getting too excited yet for the third quarter, but clearly it does suggest that as inflation eases, consumers and corporations are still fairly resilient, and that should bode well for us to eke out some positive growth in the third quarter.
Great, and as I've said before, Bookbinder family helped us in back to school shopping, which we continued even into this week. So we're going back to school tomorrow here in Massachusetts. So an exciting day. My girls are happy about it. Some kids are not. but my girls are happy to be going back to school. So thanks for that, Jeff. Good discussion. Especially that last segment, I think, about the recession risk. I think people should maybe not be so concerned about that right now, but maybe if we do get more weakness in the job market, that'll be something to look at for year end. So we'll go and stop there. Thanks everybody, as always, for listening. We greatly appreciate your support of the LPL Market Signals podcast. Thank you, Jeff. Another Jeff and Jeff show on the podcast. We'll be back with you next week for another one. Again, thank you all for joining.